Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of business finance. And today we've got a report from Transportation and Logistics Systems Inc., which sounds like it could be about trucks and planes, but as we'll see, it's more about how they're shuffling around their stock and debts to keep things moving. You could say they're really trying to make a deal happen. All right, so what's the big news from Transportation and Logistics Systems Inc.? Well, it looks like they've been busy making some important agreements to sort out their ownership structure and pay off some debts. Essentially, they're trading different types of preferred stock and settling up with a creditor. Let's dive into the first big deal, the exchange agreement. This happened on July 8, 2025, and it's all about swapping one kind of stock for another, and also dealing with some money that was owed in back dividends. Transportation and Logistics Systems Inc., or the company as they call themselves, here entered into this agreement with someone who used to hold their Series E and Series G convertible preferred stock. These aren't the normal stocks you'd buy on the market, they're more complicated. So what exactly are they exchanging? Well, they're getting up a bunch of Series preferred stock, which was about 4.92% of all the Series G shares out there. And they're also settling a significant amount of back dividends that were owed on these preferred stocks. That's around $4,680, $2.43 in accrued unpaid dividends. What do they get in return for all this? They're issuing a new kind of stock called Series J Senior Convertible Preferred. Stock, specifically 2468 shares of it, this new stock, is also described as having a par value of 0.001 per share. And it's meant to be a senior type of preferred stock, meaning it has priority over other types of stock in certain situations. Importantly, this exchange was set to be effective as of June 1, 2025. Now, there were some conditions for this exchange to actually go through. The company had to issue the Series J preferred stock. No government body could stop the exchange, and the company's promises made in the agreement had to be true and accurate. In a big way also, the company's common stock couldn't be suspended from trading by any government. This last part is pretty standard. It basically means they need to be in good standing with regulators. Next up is the settlement agreement, also dated July 8, 2025. This one is about clearing up some outstanding debts. Instead of paying cash, the company is issuing more of that Series J preferred stock to settle what they owe to a creditor. So what's being settled here, we're talking about approximately $16,000 in what they call outstanding liabilities, which are essentially debts or obligations that the company owes to this creditor. In exchange for settling these debts, the creditor is getting 160 shares of that Series J preferred stock. This settlement also had some conditions to be met, much like the exchange agreement. The company needed to issue the Series J preferred stock. And there was another important condition that at least 50% of the outstanding shares of both Series E and Series G preferred stock had to have been exchanged for Series J shares, which the report states has actually been satisfied. So that hurdle is cleared. And again, we see those standard clauses about the company's promises and statements being true and accurate, and also the common stock not being suspended from trading a recurring theme to ensure they're operating within normal rules. The report also mentions that the full details of these agreements are in exhibits attached to the filing exhibits that are pretty important for understanding what's really going on behind the scenes. Now let's talk about how these shares are being issued. The filing clarifies that the Series J preferred stock going out in the exchange agreement is being issued under an exemption from registration called Section 3 Act 9 of the Securities Act of 1933. This is often used when two companies are exchanging securities, or when a company exchanges its own securities for another exchanges its own securities, or when a company exchanges its own securities for another of its own securities. The Series J preferred stock being issued in the settlement agreement, on the other hand, is being done under Section 4A(2) of the Act. This is a common exemption for private placements of securities, where the issuer sells to a limited number of accredited investors and doesn't engage in a public offering. This means the shares aren't being sold to the general public in the same way as stocks on a regular exchange. And it doesn't stop there. The common stock that can be obtained by converting these Series J preferred stock shares will also be issued relying on that same Section 4A(2) exemption. This tells us that any future movement of these shares into the public domain will likely follow a similar private placement or limited offering route, rather than a broad public launch. So what does all this activity mean for Transportation and Logistics Systems Inc.? Well, on the surface, it looks like they're actively managing their capital structure. They're using new stock to settle old obligations and clear up back dividends. This can be a positive sign as it shows a move towards simplifying their share capital and potentially reducing debt or past due amounts. The company's IRS employer identification number is 2631066763. This number is unique to them and it's important for their tax filings, but for us investors, it's more about confirming this is a legitimate business entity reporting its activities. The commission file number 00134970 is what the SEC uses to track filings for this particular company. It's like their internal case number with the securities regulators. Now, looking at the broader picture here, Transportation and Logistics Systems, Inc. seems to be in a phase of restructuring and settling its affairs by issuing new preferred stock to clear away old preferred stock and accrued dividends. They're essentially cleaning up their balance sheet. This is often a necessary step before a company can move forward with more significant growth plans or perhaps attract new investment. It suggests the management is proactive in addressing past financial commitments. However, we need to remember that issuing new preferred stock can dilute the value of existing common stock unless the company's underlying value grows proportionally. The fact that they're using this mechanism to pay off debt and dividends also hints that they might not have had readily available cash to do so otherwise. This could indicate some financial pressures or strategic decision to conserve cash for other operations. The reliance on exemptions like Section 4A2 for issuing securities suggests they are not making a broad public offering of these new shares. These are likely more controlled issuances to specific parties involved in the exchanges and settlements. In essence, Transportation and Logistics Systems Inc. appears to be navigating a complex financial landscape. They are using financial engineering to manage their obligations and shareholder base. The story here isn't about a massive revenue jump or a new product launch, but about the internal financial mechanics that keep a company operational and compliant. The key takeaway is that they are actively working to resolve past financial complexities by issuing new equity, which is a common strategy, but one that investors should always watch closely for its dilutive effects and its implications for the company's future cash flow. Alright, that's our breakdown of Transportation and Logistics Systems Inc.'s latest filing. What's your take on these deals and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.